You check your 401k balance. It says $1 million. Congratulations, you're a millionaire, right? Wrong. You're the custodian of a tax liability. That million? You actually have about $700,000. The rest belongs to a silent partner who contributed nothing, took zero risk, but gets to decide their cut based on whatever tax rates exist decades from now. Today, we're exposing the math nobody shows you about traditional 401ks and why the most common retirement advice might be the most dangerous. Here's what they don't tell you when you sign up at 22. A traditional 401k isn't just a retirement account. It's a partnership agreement with the IRS. And it's the worst partnership imaginable. You put up 100% of the capital. You take 100% of the market risk. If stocks crash 50%, you lose, not the government. But when you win, when your money grows from 10,000 to 1 million, the government taxes the harvest. They let you keep the seed corn tax-free, specifically so they could take a massive chunk of the crop later. And here's the terrifying part. The percentage they take isn't fixed. When you contribute today, you're agreeing to pay whatever tax rate a group of politicians decides 30 years from now, based on how desperate the country is for revenue. You're signing a blank check to your future self. The standard advice says you'll be in a lower tax bracket when you retire. But let's think about this. Do you plan to be poor in retirement? No. If you're watching this, you're building wealth. You'll have a paid-off house, rental income, Social Security, and massive required withdrawals from your portfolio. Here's the reality check. We're sitting on $34 trillion in national debt. Medicare and Social Security are facing insolvency. The interest on our debt now exceeds the defense budget. Do you honestly believe tax rates will be lower in 20 years? Today's tax rates are historically low. The top rate in the 1950s was over 90%. If rates revert even halfway to historical averages or spike to pay for our debt crisis, your tax savings today will evaporate. You saved 22% on the seed to pay 40% on the harvest. That's not tax planning. That's financial self-sabotage. Let's run the numbers. You've been a good saver. You built a $2,401,000. You retire thinking you'll withdraw what you need. But the government says no. At age 73, you're hit with required minimum distributions. The IRS forces you to withdraw money whether you need it or not. On $2 million, that's about $80,000 per year. That $80K gets added to your Social Security, which triggers 85% of your Social Security to become taxable. Your high income doubles your Medicare premiums through IRMA surcharges. Every dollar you withdraw is taxed at an effective rate far higher than what you saved 30 years ago. You trapped your wealth in a tax prison, and the warden is charging rent to get out. Imagine you're a farmer. You buy a bag of seeds for $10. Tax is $1. You plant them. 30 years later, you have an orchard producing $10,000 in apples every year. Would you rather pay tax on the $10 bag of seeds or tax on the $10,000 of apples? The traditional 401k taxes the apples. The Roth 401k taxes the seeds. With a Roth, you pay taxes now. It hurts today, your paycheck is smaller, but that money grows tax-free forever. When you withdraw in retirement, the IRS gets zero. If tax rates go to 90%, you don't care. Your rate is locked at zero. You own 100% of your wealth with no silent partner. Even taxable brokerage accounts beat traditional 401ks in many scenarios because you pay capital gains tax, currently maxing at 20%, instead of income tax that can hit 37% or higher. Here's the darker reality. The Secure Act changed everything for inheritance. Your kids used to be able to stretch inherited IRA distributions over their lifetime. Not anymore. Now, they must drain the account in 10 years. Your children, likely in their peak earning years, will stack your massive retirement account on top of their salary. They could lose 40 to 50% of your life's work to taxes in a single decade. The traditional 401k is terrible for generational wealth. It's a bomb that explodes on your heirs. So here's what you do. Log into your 401k right now. Look at that balance. Multiply by 0.70. That's your real money. The rest belongs to the government. If your company offers a Roth 401k, switch your contributions immediately. Yes, your paycheck drops slightly. Eat that pain now. You're buying insurance against future tax hikes. If there's no Roth 401k option, contribute up to the company match, then pivot to a Roth IRA. Max that out, then use a taxable brokerage account. Stop optimizing for today's tax return and start optimizing for your lifetime effective tax rate. Don't let your life's work become the solution to Congress's spending problem. Be the partner who dictates the terms, not the one who just signs the blank check.